Hey everybody, hope everyone's doing well and had a good day. This is the overview of the Emini 5-minute chart for Friday, October 11th, 2024. And here's the daily chart, and here's the information we had going into today. We have a 4-bar bull micro channel, and yesterday it was a trading range day, and it's an inside bar. And the fact that it's a trading range bar and a 4-bar micro channel reduces the probability that there are sellers below the bar, so probably more buyers below yesterday's low. As far as selling above yesterday's high, some traders will, but the day before, October 9th, the high of that bar is so close that the market may have to get there first, but there might be sellers above here, betting that the market is in a trading range. The bulls are trying to get a breakout of this trading range. We had the breakout on the 9th, pullback, trying to get continuation. The bears are hoping the trading range bar was disappointing enough for the bulls that there will be sellers at the new high and that the market will fall back into this range. Now the market might be in a bull trend. It's channeling up with higher highs and higher lows. But this was enough sideways, big down, big up, big down, big up, tight trading range here, and lots of overlapping bars. So there's a lot of trading range behavior, but through here, the bulls are doing a good job keeping many consecutive bars above the daily moving average. If we look at the daily chart from this point of view, just over the past maybe 15 bars, market's in a tight trading range, and maybe this is a rally, so leg 1, deep pullback, leg 2, pause, maybe leg 3, with lots of trading range behavior, getting far from the moving average. So the problem for the bulls, let me just pull this up one more time. If a trader is buying, stop below here, they buy the close. There's their 1-to-1 target. They need to be 60% certain that the market is going up here before it's going down here to take this trade. Whenever you take a trade where the reward is equal to the risk, you basically need 60% to break even over time when you factor in commissions and mistakes and slippage. So if you're taking 1-to-1 trades, you really want a winning percentage of at least 70%. But the point is, traders buying here, they need momentum. They need the momentum to continue. And if we start to go sideways, the traders buying the close up here may just bail out of the trade. Similar to over here, there's momentum to the upside, but when we start going sideways, we have to go back and test the moving average. And as far as today, I have yesterday's high drawn, and I also have the high of October 9th drawn. So that's the prior 2 bars here on the daily chart. If we look at the context from the close of yesterday into the open of today, this rally from bar 68 to 77, that was a strong enough breakout that the odds were there would be buyers below and a second leg up. And bar 1 could have been that second leg. But when you look at bar 1, you know it's strong enough for its own second leg and probably buyers below. And if we look, it looks like there were buyers around the midpoint of the bar. So bulls, they get this big bar on bar 1, but they don't want to buy the close. It's a big bar, so big risk. Maybe stop below 1 or stop all the way down here or here. Rather than buy the close, they'll buy the 50% pullback, and they'll even buy below bar 1 if we got there. The bears hoping that bar 2 would be disappointing enough for the bulls so that they would sell out of longs at the close or at the new high. But of course, in this case, it was not enough. Look at the lack of bear bars from here through here. There's just not enough selling pressure. And if this is a trading range, we look back at yesterday's high. If this is the trading range, and this is where we're at coming into the day. This could be the high of the trading range. And the bears know that, and the bulls know that. So the bulls don't want to sell until we're higher in the range, and the bears don't want to sell until we get to the top of the trading range. And that is what creates a vacuum effect. So we start getting bull bars, nothing for the bears to sell. We have a micro channel since bar 1, and technically, since there's no pullback, this is a spike. It doesn't look like a great breakout, but if you look at a 15-minute chart, this is a pretty decent 2-bar breakout. And then we're continuing. Now it's a 3-bar breakout on the 15-minute chart. And look at bar 8. Bar 8 is breaking far above the prior day's high and the high of 2 days ago. So far, it looks like a pretty decent breakout. The bulls are hoping that we have a measuring gap. So from the low of bar 1 to the high of bar 7, the breakout point, the bulls are hoping we reach this measured move. Some traders will buy the close, others want to buy a pullback, maybe 50% of the bar. And then you get follow through on bar 9. So good for the bulls. We're probably going to get here. But the problem for the bulls, maybe your stop is below bar 8. You buy the close. Here's your 1-to-1. Now, in reality, traders are not going to risk all the way down to here or down here. What they might do is put a stop at a measured move down of a bar. So maybe they're long, they put a stop here, and they just keep trailing the stop. You can see this is the only pullback we've had today. And if we look, the market only fell 2.5 points below the low of the prior bar on bar 7. So even if you trailed to stop 3 points below the low of every bar, you'd probably be safe. And you can see the market got to that target, the measuring gap, in a hurry. Now we're starting to get a trading range bar overlap, lots of selling into the close. We're at a target, so we may have to pull back here. This is one of those situations where it's good to have a default exit, and when the market's racing far from the moving average, it's usually best to get out below a bar closing below its midpoint. So when you get a bar like 15, usually it's better to just get out and look to buy again lower. You know this should get a second leg, but we broke out of 2 important prices, the highs of the 2 prior days on the daily chart. And these are going to be test magnets. Traders who were selling above the trading range bar yesterday, selling above the high of the 9th, they got trapped on bar 8 and all through here. And that makes these resistance areas now support. So bulls will look to buy here and here. And this is a target for the bears. The bears sell here, they sell more below a bear bar like 15. So let's say you sold here, sell more here. The bears are hoping we get back to the magenta line and they can exit the first trade, break even. But if they're so disappointed by the rally that they'll just take break even on the entire trade, then they'll look to get out at this red line. 3-bar micro channel for the bears, strong enough down for a second leg, sellers above. And then a 4-bar micro channel, sellers above, probably going to get a second leg down. But this rally also needs a second leg. And then we had 17 through 20. And even though we have some weak bars, a bear bar, big tail above this bar and this bar, this rally was strong enough for its own second leg sideways to up. So this is a pullback of a pullback. We have a rally, a pullback, and then a pullback of the pullback. Remember, this bear breakout needs a second leg down. And then was this the second leg down? I don't know. We tested the low close. We didn't quite get there. And typically at a minimum, that's what the bears want. Sell the close bears, 17, disappointed. Look to get out break even. They don't get the chance there. And that's sort of the point about trapped traders and a second leg up for the bulls. Even though this looks weak, the market moved a fair distance from here to here. And there's bears who sold this low tick, and they're looking to get out at break even. And maybe, we take the bear who sold the low tick of bar 17, they sell more below 21. There's their average price. The market vacuums to it and then goes sideways. Bears buy back shorts. Bulls know this needs a second leg, and they can buy for a scalp up. But lots of sideways trading. It's a triangle. We're getting lower highs and higher lows. Vacuum down, vacuum up. Typically, you see a bar like 25 in a tight trading range like this. Bulls will take profits, and bears might use it to initiate shorts. Disappointing follow through, high 1, sellers above, and probably going to test lower. The minimum target for the bears after this breakout is a test 1 tick below the low of bar 17. But there are other targets below too. Remember the highs of the prior 2 days. And what about a 50% pullback of the rally from bar 1 to bar 12? That's right in the middle. So there's a cluster of magnets here that the market will likely want to test. And what about a leg 1 equals leg 2? That gets you down there as well. It depends on how you draw it, but you can see lots of targets below for the bears. Like I said, the market is contracting. We have a contracting triangle. It's breakout mode. About 50-50. We've gone sideways for about 15 bars. Try to get a bull breakout, breaking above the bear trend line, but immediately failed. And then getting a bear breakout attempt with follow through. Good for the bears, probably going at least a little bit lower. More follow through, good for the bears. Further trapping the bulls, we crossed the moving average. And this is strong enough for a second leg down, probably sellers above. Reversal bar 36, but 5 or 6 bar bear micro channel. The odds are they're sellers above. We trigger above bar 36. Traders will sell for at least a scalp down. Overall, we know this is a more major breakout than this, even though this should get a second leg. It's had the minimum requirement, and we need to keep in the back of our minds that the bull breakout should get a second leg, even if we go sideways here for a little while. Leg 1, pullback. Leg 2, pullback. Leg 3. So bar 41 might be a third leg down. We're testing the high of the 9th. And then look at bar 42. If we look at the 50% level of the rally from bar 1 to bar 12, the price is 58.44 3/4. 42 low, 58.45. So the market reversed up 1 tick above the 50% pullback level. And that's a common area of support. Bar 42, strong enough up for a second leg. Bears selling below bar 41 are trapped. They'll use any pullback they can get after bar 42 to exit their shorts with a smaller loss. Bulls who didn't buy because tight bear channel, they're looking to buy a pullback as well. So maybe a 50% pullback of bar 42. When we pull back, looks like we're testing around 50%. We fall a little bit below it, but then we start finding some buyers. Low 2, it's a double top, but tight trading range. And we think about the structure as a whole. This should get a second leg, and this is all minor. It's all within the bull breakout. So at best, For the bears, this is a trading range, and we may have just found the bottom on bar 42, and the high could be all the way up here. So if you're taking a low too short in the lower portion of a trading range, you need immediate follow through. And if you don't get it, like on bar 50, bears selling, taking a chance, they probably get out above bar 50. And for always in traders, bulls can buy above 50, and again, bears who sold for any reason, anywhere, probably get out above 50. Good entry bar 51, probably going at least a little bit higher. Trap traders here getting tested. So I mean, when I say trap traders here, any trader who sold above bar 49 got trapped on 51, 52. Came back and tested it on 54, but could not close below, and we get a second leg up. This is all enough sideways trading to convert the market into a trading range. As strong as the rally was on the open, it was unsustainable. And this is typically what happens. If you have Al's encyclopedia of chart patterns, you know when you have a rally like this on the open, the most common outcome is that the market goes sideways for the rest of the day. There's only a 20% chance the market continues to rally all day, and a 20% chance we get a huge bear reversal. So more likely the market's in a trading range, and the bulls have a target above. They want to get one tick above the high of bar 12. Leg 1, complex pullback, maybe leg 2. And look at the selling pressure through here. Lots of bull bars closing on their highs, bear bars not getting follow through aside from here, but this was weak follow through. Bear bar, no follow through, bear bar, no follow through. Starting to vacuum up. So it's looking decent for the bulls here, but the problem might be leg 3. 1, 2, 3. We're getting high in the range. Market pulls back. Okay to exit longs below 59, but still always in long, tight bull channel. We get a little bit of a pullback down on 62, but that's 2 legs down. Leg 1, pause, and then a climactic second leg. The market tested this stop order. There was a stop order sell below 49. Bears got trapped. They didn't quite get there on 62. So okay to buy above 63, still always in long. Tight bull channel, should get a second leg up. Then we have a bull bar closing on its high. Technically it's a high 1. Some traders see it as an implied high 2. Like I said, leg 1, pause, leg 2. And then nothing to sell. A little bit of a vacuum test of the high of the day on 68. And that will attract profit taking. Like I said, the market at this point is in a trading range. So even though you can say we have higher lows, higher highs, the reality is this is a trading range. And you know that 80% of breakouts of trading ranges fail. So if you're long, better to take profits up here, and bears will start selling. Also look at the rally. Leg 1, pause, leg 2, pause, leg 3. So probably limited upside. The bulls are trying to get a breakout, but does this look like a strong breakout? Remember, this broke out far above some major resistance areas. This red line, the prior high of the day, the bulls need to get a bar, ideally like bar 8, and they're getting bars with tails above, an inside bar, a couple dojis. You know, we have a high 1 buy at the top of a trading range, probably sellers above. The bulls continuing to try, but obviously going sideways, tight trading range, possible final flag. We've rallied for 20 or 30 bars. And like I said, tight trading range, so possible final flag. Sellers above may get a deeper pullback. Dangerous to be long at the top of a trading range. Bear bar closing near its low, 74. Bulls will get out, bears can sell. We drifted sideways to down. And we tested just about to the middle of the range at the end of the day. And that put a fairly significant tail on the top of the bar on the daily chart. So if you think about the day's price action, you look at the bar on the daily chart. It's a good looking bull trend bar, but a tail on top. And you look in here, the market only rallied for about 12 bars and then went sideways for the vast majority of the day. Stop order trades today, there was a high one above bar 3. And when you consider the prior day's price action, the market was always in long coming into the day, and bar 1, it stayed that way. Also, quick note, only about, in general, 20% of days have the low of the day on bar 1, the high or the low of the day on bar 1. So today was one of those days. Stop order buys above 3. You could buy above 5 or 6, always in long, buy above any bull bar. 8, buy the close 9, buy the close 10. We're getting dangerous, far from the moving average up here. And like I said, it doesn't matter where you bought. If you bought the high tick of 12 and you get bar 15, usually just better to get out below 15 and reassess. There might be some sellers below 15. Tight trading range possible, final flag, and getting buy climax, pause, buy climax, sideways, and then a good looking bear bar far above the moving average. So some traders will sell, but they know it's unlikely to be the start of a bear trend after this rally. So if anything, bears are selling for a scalp. Through here, this is a tight trading range. Some traders, they're expecting a second leg down after this sell-off, and you get bar 21, but then we have a 5-bar micro channel inside doji, not a great sell. Traders would prefer a low 2, low 227, but same problem, 5-bar micro channel and a couple of dojis for the signal bar. And for the bulls are hoping for a second leg up, so leg 1, tight trading range. They'll buy above any of these bull bars, 19, 24, 29, but these are fishing entries. So you take these trades hoping for good entry bars, the market goes your way immediately, but if it starts to hesitate and stall and reverse, then traders will just get out. And that's what's happening all through here. You buy above 19, and 20 looks pretty good when it's on its high, but then it closes around its midpoint and you go sideways, so traders bail out of the trade. Here, 24, good looking entry bar, 25, but you're still within the tight trading range. Then you start to go sideways, bulls will bail out. 29, you buy above here, good looking entry bar, but same problem as this one. You're still within the range of the tight trading range or the triangle. And as soon as bar 31 starts to hesitate and go down, you can see there's a tick gap from the close of 30 to the open of 31. There's urgency to go down on the close of this bar. And then we had a give up here by the bulls, 32, 33. So finally a decent looking stop order trade for the bears, 32. But at this point, this is a low probability trade. Probably 40% chance you get a swing down. Higher probability to wait for the breakout and follow through, sell to close 33, sell below 34, or sell to close. And maybe go for a measured move down. There's a stop order buy above 42, but it's not ideal. Big bar, so big risk, and you're buying right at resistance. Better to wait for a bar like 47. It's a high 1, but you can count implied legs. 1, 2, 3. So on a smaller time frame, this is more like a wedge bull flag. Bull breakout, 3 legs down, reversing up. And then I thought, by bar 50, bears need to give up above 50. Bulls can buy, always in long through here, buy above any bull bar. But then reasonable to get out below 59, so some bears might sell. But again, after a tight bull channel, just like over here, you're selling for a scalp. You're not expecting a bear trend. I thought 63 was a reasonable stop order trade, 66. Up here, not so ideal at the top of a trading range, especially when it starts to go sideways. IOI, reversal pattern at the top of a trading range, reasonable to sell below 74, but your follow through is not great. But of course, if you held the trade, you did pretty well. So where do we go Monday? Even though we have a 5-bar micro channel, it's really not all that ideal. We have a bear bar for the first bar. We have an inside trading range bar, lots of trading range price action through here. And I mentioned this earlier, if you're buying and your stop's down here, you need a 60% chance we get up here close to 6,000 before we pull back and test down here. So the bulls really need the momentum to keep up, but this momentum isn't great. Bear bar, we rally, we have a sideways bar, we rally again, but remember what the 5-minute chart looks like on this day. The vast majority of this day's range, pretty much the entire day's range, was made in the first hour of the day. And for the remainder of the day, the market went sideways, so this bar is not as strong as it might appear. We're also breaking out above an inside bar, and typically the market comes back and tests the high, or really the midpoint, of the inside bar within a couple of bars of breaking out. So I think the upside right now is limited. The context isn't great, far above the moving average. The trader's equation is not great for the bulls. So I'm expecting disappointment at the start of next week for the bulls. All right, thanks everybody for watching, and I hope everyone has a good weekend.